When we think about the cost of climate change, our minds usually jump to things like flooded cities or damage from big storms. But what if the biggest costs aren't the ones we can see? What if they're actually hidden, deep inside our financial system? Well, today, we're going to go on a hunt for a hidden risk, one that could be quietly lurking inside one of the biggest markets in the world.
And it all starts with this simple but absolutely enormous question. Are the financial markets, the people with trillions of dollars on the line, secretly pricing in the long-term risks of climate change, even when it's not making headlines?
So picture this. It's 2019, and one of California's biggest utility companies, PG&E, suddenly files for bankruptcy. And the reason why? Billions, with a B, in liabilities from these insane wildfires that came after a historic drought. The Wall Street Journal even called it the first climate change bankruptcy. And that sent a real shockwave through the financial world. It was a concrete dollars and cents consequence of a changing planet.
So you have to wonder, right? Was PG&E just a fluke, a total one-off event, or is this exact kind of risk hiding in plain sight in companies all over the economy, just waiting for its moment? I mean, if it is, you'd think the smart money would already be reacting to it, so let's go find the evidence.
And the perfect place to start our hunt is the U.S. corporate bond market. Why there? Well, this is where big companies go to borrow trillions of dollars. And bond investors, they are famously cautious. They absolutely hate risk. If anyone, and I mean anyone, is going to charge companies extra for being exposed to danger, it's going to be them.
Okay, so let's get into it. Before we can find out if investors are pricing in climate risk, we first need a really solid way to measure it. I mean, how do you actually put a number on a company's physical exposure to something as massive as climate change?
Well, the old way of doing it was, frankly, a little too simple. You just look at where a company's headquarters is located. But that doesn't really tell you much, does it? A company could have its fancy HQ on a mountaintop, but every single one of its factories could be right on the coast. So the research we're looking at today uses this brilliant new method. It analyzes a company's entire geographic footprint. We're talking every single store, every factory, every office, and it uses sales and employee data to build a complete picture of where their real-world risk is.
And the specific risk they decided to measure is sea level rise, or SLR for short. The researchers used a model to estimate the economic damage as a percentage of GDP for every single coastal county in the U.S. from a 40-centimeter sea level rise. What this gives us is a super precise, quantifiable risk score for any location, which we can then map onto a company's entire operation.
All right, so we have our hunting ground, the massive bond market, and we have our high-tech tool for measuring risk. Now, finally, we can answer that trillion-dollar question.
Are the people lending out all this money, the bondholders, are they actually demanding higher interest rates from companies whose buildings and factories are more exposed to rising seas? What do you think?
The answer is a clear, unambiguous yes. The data shows that for a standard increase in a company's sea level rise exposure, investors charge an extra 7 basis points on their loans. Now, I know what you're thinking. 7 basis points? What on earth does that even mean? Well, it might not sound like a lot, but for a huge company borrowing billions, it adds up fast. We're talking about a 3% increase in their average borrowing cost. The easiest way to think about it is this. It's kind of like a credit score, but for the climate. Just like a bank charges you a higher mortgage rate if you have a bad credit score, bond investors are charging companies more interest for having a bad climate score.
But get this, the story gets even more interesting. This climate premium isn't just applied to everyone equally. The market is actually being really sophisticated about how it distinguishes between different kinds of risk.
Turns out, investors penalize companies that have all their eggs in one basket. So if a company has all of its factories concentrated in a few vulnerable coastal areas, boom, it pays a significant climate premium. But what about companies that are super diversified, with operations spread out all over the country? Well, investors see that they've hedged their bets and there's no significant premium at all. Smart, right?
And the effect is strongest in industries with a ton of physical assets that you can't just, pick up and move. We're talking about things like oil refineries, power plants, and shipping ports. The energy sector especially faces the highest risk premium, which, when you think about it, makes perfect sense given all its massive fixed infrastructure is often located right in those coastal zones. So when did investors start paying attention to all this? The data points to a really clear turning point, the 2015 Paris Agreement. Before this huge global accord, the researchers found no real evidence of a climate premium. It's like the market was just ignoring the risk. But afterwards, as media and political attention just exploded, that premium appeared and became significant. It seems awareness really does have a price tag.
So all of this evidence builds up to a really fascinating conclusion. Because even though the market seems to have this all figured out, there's one major player in this whole game who seems to be missing the memo entirely.
So let's be super clear on what we found so far. The investors, the people with actual skin in the game, with real money on the line, they are quietly and efficiently calculating the physical risk of climate change, and they're building it directly into the price of debt. The market is working.
But what about the official referees of the financial world? You know, the big credit rating agencies like S&P and Moody's. Their entire job is to officially stamp a letter grade on a company's riskiness. So, are they including sea level rise in their formal ratings?
And here's the final twist of the story. The research found absolutely no evidence that credit rating agencies account for a company's sea level rise exposure when they issue a bond rating. So while the market is reacting, the official scorekeepers, they seem to be looking the other way.
And that just leaves us with this one final provocative thought. You have a situation where the collective wisdom of the market, trillions of dollars, sees a clear and present danger. But the official rating agencies don't seem to reflect that risk in their scores. So, when the players on the field and the referees in the booth totally disagree on the call, who are you supposed to believe?